So, good morning, my colleagues, and I do hope everyone is well. By my clock, it's 5:23 a.m. in the morning. So, I want to pick up for part two on chapter one where we left off. And as I said, I want to talk about debt markets and interest rates. So, they define a security. Now, what is a security? A lot of you know it as either stocks or bonds, right? And I'll highlight this word here. Right, so that's it's a financial instrument, but let me click on it. A claim on a borrower's future income that is sold by the borrower to the lender, also called a financial instrument. Okay? So a security is a claim on the issuer's future income or assets, any financial claim or piece of property that is subject to ownership. A bond is a debt security that promises to make periodic payments for a specified period of time. So you'll hear this as a debt security or bond. You'll hear this thrown around a lot, right? And you'll hear both of those words used to describe bonds. So let me see what happened here. If I can highlight this, debt security, and now can I highlight this? What will it do? Yes, it does. All right. Okay. So debt markets are often generically referred to as bond markets. Okay, so that says what I was just saying. So you'll hear those words are used interchangeably, and basically they're a big part of economic activity. Bonds are money borrowed by corporations and governments. And you've probably heard of treasury bills and treasury notes and treasury bonds. As you know, the government is always borrowing money. The government is broke, and you must know what our national debt is, right? You probably heard that. And companies borrow too, because corporations want to, change, upgrade their R&D, or they put a new factory up or a new product line, and they want to basically finance their activities in general. This is a general statement, which is good. Whatever the activity may be, they want to finance it. And basically, how interest rates are determined right off from the bond markets. Okay? Interest rates are determined from the bond market. Okay? All right, so what is an interest rate? Just so everyone knows. An interest rate is the cost of borrowing or the price paid for the rental of funds, usually expressed as a percentage of the rental of $100 per year. Okay, so we're going to learn and talk a lot more about interest rates. All right, many types of interest rates are found in the economy. So there's mortgage interest rates and car loans and student loan rates, right? Which they don't list here. And there's, interest rates on T-bills and T-bonds and you name it. There's tons of interest rates that we have to know about. All right, so from a personal standpoint, so again, I harken back to the personal level, right? High interest rates might deter you from buying a house or a car because the cost of financing would be high. Conversely, high interest rates might encourage you to save because you can earn more interest income by putting aside. So it's a good and bad, right? When it comes to interest rates, and it depends on what side of the coin you're on. But on a more general level, right, interest rates have an impact on the overall health of the economy because they affect not only consumers' willingness to spend or save, but also business investment decisions, right? And right now, the Fed has the interest rates very low, and they're trying to encourage people to spend money or borrow, and companies to borrow. So you can see here what happens. High interest rates might cause a corporation to postpone building a new plant that would provide more jobs. All right, because changes in interest rates affect individuals, financial institutions, businesses, and the overall economy, it's important to explain substantial fluctuations in interest rate over the past 40 years. So for a 3-month T-bill, Here they talk about the three-bill team. I don't know if they have a chart. We'll see. It peaked at there was a lot of inflation in 1981. I was living during that period, right? The interest rate fell to 3% in 1992. It went down, and currently it's very low now, right? Since the pandemic, rates have really been pushed down. You can see uh, fell to near zero. This was the great financial crisis in 2009, the mortgage crisis, right? So here is interest rates on selected bonds, okay, from 1950 to 2017. This is kind of what I was referring to. I'm glad they got this. So you can see here, this light blue is the 3-month Treasury bills, and this dark blue or green, I guess, is corporate bonds, and here's Treasuries, long-term government Treasury bonds in red. But you can see how they all basically move in unison here. They move in unison, but you notice the spread is different. Depends on the time, right? Look, here's a 3-month. The 3-month has got a much lower interest rate because there's a much lower risk than you would get with corporate bonds. But even though they move in unison, there's a quite a difference in gap between them, and that's what they're driving at here. And by the way, just so everyone is aware, they really give you. This book is great. They give you the source of all the tables and everything, and all the diagrams and the figures. So you might want to see if you can pull these up. This one's from the St. Louis Fed, from their Fed database. All right, so in chapters 2, 4, and 6, the even tells you ahead, we examine what an interest rate is and the role of the bond markets in the economy, how the common movements in interest rates come about, and why the interest rates on different bonds vary. All right, so now we pick up with the stock market, right? If you saw what we had, let me scroll back up a little. So here was debt, right? This was debt, which was bonds, and now we will go into the stock market, right? So basically, this term is called common stock, and they'll refer to that just as stock. Now, I own stock, and some of you, I'm sure, probably own stock through maybe Robinhood. So this basically represents a share of ownership in a corporation. With bonds, you don't have ownership, you just loan them money. You get your coupons, otherwise known as interest rates, every 6 months. And then when you get those interest rates, at the end, when your bond matures, you'll get your money back. But with the stock market, technically it's got an infinite life, and you will get dividends or not dividends, but you're a stakeholder or a shareholder, and you will vote on things, and you have a say in what goes on in the market. And it's important to do a lot of research when you buy stocks. There's a lot of different variables you can come up with there. So you can see it's a claim on the earnings and assets of the corporation. Issuing stock and selling it to the public is a way for corporations to raise funds to finance their activities. The stock market, in which claims on the earnings of corporations are traded, is the most widely followed financial market in almost every country that has one. And like me and everyone else, we simply call it the market. We say the market was down today. The market had a great day. The market had a bad day, right? So when you invest, you want the market to have good days, right? Unless you sell stock short. Selling stock short is selling stock you don't own. Then you buy it back at a lower price. All right, so a big swing in the prices of shares is always a major story on the news, and that big swing is known as what? There's a word they use for that. The big swing is called volatility, right? Everyone should know. Volatility. So people speculate on where the market is heading and get very excited when they can brag about their latest big killing. And they don't really tell you too much when they lose a lot of money. And you can see this comment. It's a place where people can get rich or poor very quickly. So here's we're going to get to figure two in a minute, but stock prices, again, here's volatile. The word volatile, I use volatility, and they jump around. Okay, so there was been bull markets and bear markets. They use bull for the bull's horns going up. That's why they call it a bull market, and a bear because his paw goes down. Okay, but you can see here's the Dow Jones Industrial Average. If you don't know, it has 30 stocks, and occasionally stocks are taken out and new ones are put in. And as you know, on the S&P index, they're putting Tesla in. Okay, so that the S&P, I believe, 500 index is going to have Tesla. All right. So, but you can see how stock prices for different periods. This was the Great Recession in 2008 here. All right. So, and here is the last couple of years. So there's varying. When things happen in the economy, it's reflected in the stock market. But overall, if you invested somewhere around here, you made a lot of money. And there are people who buy for the long term, and the people who speculate, day traders. I buy for the long term, and I try to take advantage of this. I figure, what the heck, you can't put money in a bank and get 0.1%, right? So this is again, the stock prices are very volatile. And here again, just for your information, is the where this came from, the St. Louis database, and it's good to know about these things. You'll notice here they give you an interactive real-time data version of this figure on their website, so you might want to go there. So again, the stock market's an important factor, right, with regard to investment decisions. So if the stock is going up, what does it mean if the stock is going up? It means that the higher price of a company's share means that the firm can raise a larger amount of funds, which it can then use to buy, do things with. I'll just say in general, do things with. Okay. All right. So as I said, when we get to chapter 2, we're going to look at the stock market, and in chapter 7, we're going to go back to the stock market. I don't know if we covered chapter 7. I have to check. All right. So it's important to know. These things are important to know. All right. So I'm about 13 minutes into this. And this is where we're going to pick up next. We're going to pick up on why study financial institutions and banking. All right. We'll pick up on here. Alrighty, everybody. Have a good holiday and take care and be safe.